Good morning, everyone, and welcome to our special tech-focused version of IRD Invest. My name's Jane Lowe, and I'm the Managing Director of IR Department. It's a pleasure to be hosting Michael Eidel, who's the CEO and Managing Director of Openpay, here with me this morning. Morning, Michael.
Good morning, Jane.
Thank you for coming and also for allowing us to support you on investor relations and public relations. So as many people would know, Openpay sits in the buy now, pay later space, which inarguably is a hot sector to be in at the moment. Despite the macro environment, the business has performed extremely well since its December 2019 IPO. And Michael will talk us through the highlights of that today and where he sees the business headed. Following Michael's presentation, which will go for about 15 minutes, we'll have 10 minutes for Q&A. If you'd like to ask a question, there's a Q&A button in the Zoom ribbon at the bottom of your screen. So please do that and we'll get through as many of the questions that we can in the time that we have. So with that, Michael, I'd now like to hand over to you. Thank you.
Thank you very much, Jane, also for your great service supporting our company. As Jane said, my name is Michael Eidel. I'm the CEO at Openpay. And it's a great pleasure to be here at this IR Department Virtual Tech Conference and present our company. My presentation will particularly focus on our differentiated approach in buy now, pay later, our business performance in FY20 and a bit of a view into the start of FY21 and some highlights of our first year as an ASX listed company. So let's get started on page 3 of the presentation. To very briefly introduce the company, Openpay has been founded in 2013 in Melbourne and is a well-established provider of payment services in Australia and in the UK. And our mission is to change the way people pay for the better. And this leads me on that page to the differentiation of our buy now, pay smarter approach, as we call it, in 3 main dimensions. First of all, we have a very flexible technical platform, which allows us to offer payment plans from 2 to 24 months, up to $20,000. Importantly, all in one customer journey and no hidden catches as we charge fees, but never interest. Secondly, we do not only focus on retail, where we have a very strong position, but we specialize in industries like healthcare, home improvement, and automotive. And with our flexible plans, these verticals provide us with a unique opportunity to make a true difference for the merchant and for the consumer. And third, our target customers are finance-savvy people with an older demographic. They use our product not as a cheap source of credit for largely spontaneous low-value purchases in fashion, in fast-moving consumer goods, but as a budgeting tool for very considered higher-value purchases across a range of lifestyle-related needs, like their health, their cars, and their home. Think of dental treatments, car services, and furniture. We empower them to spread their payments over a longer period and to manage their cash flow smartly in line with their salary pay cycle. Our customers have control over their spending. Earlier this year, and this is probably our 4th differentiator, we have announced our market entry into B2B with Openpay for Business and Woolworth as our inaugural client, and I will discuss this in more detail later on. Now over to page 4, please. FY20 has been a year of exceptional challenges, bushfires, COVID-19, and being a only recently listed and young company, but also some extraordinary achievements. We have been able to significantly grow our buy now, pay smarter business in our home market across the industry verticals where we are focusing on, as I said, healthcare, home improvement, and automotive, despite the challenges and uncertainties due to the various COVID-19 lockdowns and obviously still prevailing in Victoria, unfortunately. As well as a significant number of new merchant agreements and launches, we have been able to enter some long-term, long-term in parts exclusive deals with integration partners like Pentana in automotive, My Health First in healthcare, or more recently MSL Solutions for golf memberships. They all provide us access to strong merchant networks and customer bases to proliferate our product at scale into lifestyle areas where our customers want to use us. We also successfully launched, as you can see here on the second column, our business in the UK with notable merchant wins like JD Sports and more recently with the Hut Group. With our clearly differentiated longer-term product, we have a strong competitive edge in this highly promising large market in Europe. We will discuss to the third point here, our balance sheet later in the presentation, but with approximately 150 million Aussie dollars of cash in undrawn debt facilities, Openpay is in a very strong funding position to enable the continuation of our growth strategy in the upcoming periods. And last but not least, to the right, we have demonstrated our responsible and responsive approach to our business and customer needs through COVID-19, striking the right balance between supporting our merchant and customers, protecting the company by preserving cash, and keeping our staff safe and healthy. This leads me to page 5 and our very strong business performance in FY20. Thank you. From the left, our leading indicators have grown significantly year on year. Active plans, as you can see, are up by 229% and active customers by 141%. These growth rates have been above our expectations. And to put them into perspective, during the financial year, the percentage of repeat customers grew to 70%, and already 42% of our customers currently have multiple congruent plans with us. This is very important for us and encouraging as customers are making it a routine to use Openpay for life's important purchases and to smoothen cash flows along their pay cycle. The number of active merchants, the graph in the middle, have grown by 52%, which is remarkable as we have put a strong focus on larger merchants and integration partners to scale more quickly. As things hopefully normalize over the upcoming month, also for essential services like car services and dental treatments becoming more accessible again, we will have a strong growth trajectory into FY21 across our online and in-store presence across all verticals. And we have seen this trend coming through with the exception of Victoria, obviously in New South Wales and other states where the take-up of e-commerce business continues to grow very, very strongly. But we see more business coming back also in these verticals, which are often delivered in-store, if you like, in a clinic, in a practice or in a car dealership. To the graph then on the right, this growth in our leading indicators has translated into 98% growth in our total transaction value, up to 192.8 million, and a revenue increase of 64% to 18 million for the financial year. Looking at these two metrics in combination, we have achieved a strong 9.3% gross revenue yield, which is simply revenue over TTV, which is at the top end of the buy now, pay later sector. Receiving fee income from merchants and consumers in Australia, particularly in our specialized verticals, which are less contested than retail, makes us reasonably immune to margin compression. The revenue mix in FY20 has been 54% of revenue from customer fees and 46% from merchant fees. As we grow and scale our businesses, there is plenty of headroom for us to systematically reduce our cost base. For example, as we rapidly grow our receivables book, we will become eligible for warehouse financing structures to significantly lower rates than specialized debt funding, which will drive interest costs down. This lever and some others like third-party fees and customer acquisition costs provide us with strong operating leverage and a clear path to mid to long-term profitability, keeping our revenue yield high and bringing costs down as we scale. Let me provide you now with some further highlights in FY20 and starting with page 6, some comments to our international expansion. In June 2019, we launched our Buy Now Pay Smarter product in the UK, our first international market. Since then, we have successfully signed and gone live with more than 24, now around 30 retailers. In May, we launched with our first enterprise retailer, JD Sports. Across all our UK merchants, we have secured now around 187,000 active plans and 108,000 active customers in our first year, with a strong positive trend into FY21. We are currently working through the process of an FCA credit authorization, which will make our offer even more flexible. And we are preparing for launch into our other verticals in the UK over the next 12 to 18 months. And just a short snapshot again on how the growth has proliferated now with JD Sports, particularly in the first quarter of the year. We have seen an enormous increase of volumes and new customers through this enterprise merchant, and we are the only provider of 3-month plans at their checkout, and they're working with Klarna, ClearPay, and Lay-By, who all offer up to 2 months, and we differentiate very strongly with our 3-month plan, and we see a massive increase of volumes and revenue with this client, just as an update on that important client. If I may ask you to flip to page 7, please. Our customer base represents people who invest in their lifestyle in a responsible and mature way. From a demographic perspective, we attract customers across all age cohorts, as you can see, with a median age of 39 years. FY20 has confirmed the trend of our customers using Openpay more frequently, and at the same time reducing the average transaction value and plan length to $272 and 3.7 months. The majority of our plans sit in the 3 to 6 month bucket, which leads to a number of advantages. It clearly demonstrates our differentiated approach, and it comes with a favorable commercial profile, particularly in our high margin verticals in auto and health. Over to page 8, please. Thank you. We have listened to our customers where they want to use our installment plans and budgeting tool, and have extended our verticals. In Q4, we conducted a soft launch into online education and sports memberships on the back of some great early merchant wins. Like recently, we announced an exclusive 3-year partnership with MSL Solutions, which gives us access to their software to 400 golf clubs and their 135,000 golfers, who will be able to use Openpay to pay their membership fees and spread their payments over time. With the same MSL Solutions partner, we have also now signed up some of the Premier League football clubs in the UK, and 2 of them have already gone live with our product with their kind of franchise products, which is a great extension of this partnership into the UK. We will see further deals coming through, which will inform a hard launch in these verticals in the first half of FY21. Now on page 9, some further details to our first significant innovation on our payment platform, Openpay for Business. With Openpay for Business, we have built out our platform capabilities to deliver payment service into a new, largely untapped profit pool of a multi-trillion-dollar B2B market. In February, we announced entering the B2B sector with an inaugural agreement with Australian retailer Woolworths. What started as a competitive tender, which we won against a credit card provider 2 years ago, has become a software as a service portal, which will enable Woolworths to manage their business customers' accounts and payments seamlessly, including applications, credit checks, approvals, and account management, all based on our technical platform. We will not fund Woolworths payment terms to their business customers, however. The agreement with Woolworths is for an initial 3-year term with an option to extend for a further 2 years. And we have started to go live in early September. So we are now 6 weeks in onboarding all of their existing customers onto our platform. And we see a very nice uptake already in growing transactions after the first 6 weeks of launch, and are very happy with the progress as Woolworths is. Over to page 10. Our response to the crisis. This page alludes to the way that we have managed the unprecedented challenge of COVID-19. At the time in mid and March, we moved very swiftly to implement decisive measures in response to this pandemic. Most importantly, we provided vulnerable customers with financial hardship support. We temporarily reduced our employee expenses by 35% to preserve cash levels, adjusted plan settings, tightened credit rules to avoid financial hardships. And we also closely supported our essential service merchants and strengthened our credit risk decisioning and fraud prevention technology. Our approach has kept the credit book in a very strong position throughout the crisis. And just in the last month, our net bad debt rate in percent of total transaction value has been at a very low 1.5%, which is probably one of the strongest ratios in the market in buy now, pay later. A few comments on page 11 to our balance sheet and funding position, which is of particular importance, particularly now in these uncertain times. As I mentioned before, we are very well funded to support our continued growth strategies, which around 150 million of cash and undrawn facilities available. Based on strong institutional demand, we raised another around 34 million Aussie dollars in a placement in June 2020, adding up to $70 million available cash at the end of FY20. We have also expanded our available debt funding through new facilities and the extension of our existing facilities. In total, we have undrawn receivable funding of 45 million in Australia and 20 million pounds sterling in the UK as at 30 June, and can extend them to significantly higher amounts in both markets. So overall, a very strong run rate to grow the receivables book and invest in technology and talent for future growth. Now, what can you expect from us in FY21 and beyond? So please turn over to page 12. In addition to our existing growth areas, FY21 will see a heightened focus on strategic, where possible, exclusive partnerships in Australia and in the UK for our buy now, pay later, but also for our B2B product to scale both of them. We will also strongly focus on extending our footprint in the UK, as I mentioned before, into our specialized verticals, and will continue to explore a merchant-led expansion into compelling markets in Europe. And another important aspect is to further enrich and extend the capabilities of our technical platform. We will focus in FY21 particularly on integrations, automation, and self-service of merchant onboarding and activation, on the continuous improvement of customer experience and conversion, and on data analytics to inform credit decisioning and fraud prevention and reporting. And as a fintech company, the continuous improvement of our core technical assets to drive sustainable growth is key to our strategy and the foundation for our ambition to ultimately become a global provider of leading payment and lending services for people and businesses. So to wrap up, despite a quite strange and difficult year in the world, we are very proud of our achievements in FY20 and now leading into FY21, and our outlook is very promising. On a more macro level, buy now, pay later has proven to be an attractive way for consumers to pay, with significant adoption in all large retail and consumer markets around the globe. Demand for what is a relatively new financial product still has grown at exponential rates and continues to increase as new markets, products, and geographies open up. And it's great news for our customers that the choice of innovative payment options has increased with recent market entries of new buy now, pay later providers and incumbent players in financial services. At Openpay, on our end, we are only just getting started. We are very confident that with our purpose-driven, responsible payment services in B2B and B2C and differentiated buy now, pay smarter approach, we will continue to grow and scale both in Australia and overseas. This has brought me to the end of my presentation. Thank you very much for your attention, and now happy to take your questions.
Excellent. Thanks very much, Michael, for a great presentation. We do actually have quite a few questions that have come through, so thanks to all those who have submitted them. First one is about verticals. So you've recently entered 2 new verticals, education and memberships. Why did you choose those segments in particular, and where do you see the segment strategy going in the future?
Yeah, it's a good question. Thank you. I think, and this is usually how we take it for anything we do. We have listened to the customer, and starting with the consumer, in a lot of interactions with customers, we have asked them what next areas of their lifestyles they would like to use us as a budgeting tool. And by the nature of where responsible, bit more older people, families, people who own cars, and kind of manage their lifestyle decently and responsibly, some of the major areas have indeed been education and sports memberships. Education, due to COVID-19, we have been focusing on online education to start with, but the plan very clearly is at the right point of time in the near future to also offer plans for schools. And we know there's a lot of demand, particularly in and around Sydney and Melbourne, a lot of private schools, high fees. And I think our differentiated approach with longer term and higher value plans can particularly make a difference for the schools and parents and their students. So that's the next one which we will focus on. More long term, we also think of utility bills in telecommunications, in energy. There are first explorations underway already to build the right product, to ensure a right product market fit. And we obviously also have already conversations with providers in that space to kind of line up the right way to approach it and create a pipeline.
Excellent. Thank you. We've got another question here specifically on verticals before I jump off to other areas. So can you provide some commentary around the adoption of BNPL in the healthcare space? And are there any leading indicators of new business being driven by the likes of the recent partnership with First Group?
Yeah, healthcare is more broadly a very, very important vertical for us, following from a volume perspective, retail and being kind of on the same level as automotive, which is also a very important and sector which we probably lead in Australia as well. We see good. We have seen very good uptake in the past, and we have onboarded a lot of clinics and practices and continue to do so. However, as particularly in healthcare, most of our services are consumed and delivered and consumed in store, in clinic, in practice. We have seen a bit of a slowdown in the growth of that business in healthcare across all the verticals like veterinary, dental, optometry, and audiology. And however, now in New South Wales over the last few months have seen kind of the business coming back and growing very nicely again, as we had seen it before COVID-19. Victoria is still a bit behind, but already there we see now more traffic and more business coming through again. And as we have discussed with our partner at My Smile Plan, for instance, recently, a dental treatment, at any point of time, you have to do it. It doesn't go away like something with your muscle or any other illness, if you like. You need to do it. So it's more deferred than that it would not happen at all. So from that perspective, I think the getting back to the new normal after lockdowns will see us taking up that strong growth rate again. And we are already seeing some first kind of positive implications of our partnership with My Health First already. But I think that's only at the very beginning after integration has been delivered to really get now into the broader market and create the awareness through their platform and then into our plans provided by the respective provider of health services. So we will see this also proliferating more broadly in the near future.
Great. Okay, I'm conscious we've got sort of 2 minutes left, so we'll try and knock over two others, quite a few on competition and consolidation. So perhaps we do one of those. You've got two major competitors in Afterpay and now PayPal, as well as a number of others. Do you think there's enough room for a company like Openpay to compete effectively? And do you expect to see consolidation in the market?
Yeah, I will keep this extremely short and a bit blunt. I think competition would be more probably Zip and to some extent Hum, but probably more Zip in these longer term plans. I see us more as a complementary service in retail to Afterpay or PayPal. They're all focusing on the short end and low value end of the merchants' products. And we get increasing requests from retailers who have been operating with these two named competitors, which bring us in to cover the higher value end with our longer term plans. And I think the competition would be really more Zip, but they are in our verticals where our longer plans and higher value plans make a particular difference. I think we are very, very well positioned, particularly in auto, health, and on also home to compete very successfully and be a number one or a number two in the market. Consolidation will happen. I think we are differentiated enough with having the majority of our books sitting from the 3-month plans. And I see more competition consolidation now in the short end, 6 weeks and 2-month plans.
Excellent. Thank you, Michael. And just one here that I can knock off quickly. Is there any research coverage on Openpay? The answer is yes to that. And if you go check out openpay.com.au in the investors section, you'll find all of the research on the company. So with that, I'd like to say thanks very much to you for presenting today.
Thanks, everyone. Thanks, Jane.